Bonds can look calm at first. You lend money to an issuer, and the issuer promises interest payments and repayment later. But the result can change because of the borrower, market rates, inflation, liquidity, currency, country conditions, and the way you buy the bond. Credit risk. The first question is simple. Who has to pay you back? That borrower may be a company, a government, a local authority, or another issuer. Credit risk means the issuer may fail to pay interest, return the principal, or make a payment on time. The extreme case is default. That is when the issuer misses a required payment. But the price of the bond can fall earlier, as soon as investors start doubting the issuer's ability to pay. A higher yield can look attractive, but it often appears because the market sees more danger in the borrower. Interest rate risk. A beginner may think the coupon tells the whole story. The coupon may stay fixed while the bond's market price moves. If market rates rise, new bonds can offer better income. Your older bond then looks less attractive to buyers. To sell it before maturity, you may need to accept a lower price. The issuer can still be paying normally. The price can still fall. So holding a bond to maturity and selling it today are two different situations. Your result depends on whether you can wait and whether the issuer keeps paying. Duration risk. Some bonds react gently when rates move. Others react much more sharply. That is where duration risk comes in. Duration is a way to understand how sensitive a bond's price is to interest rate changes. A bond with higher duration tends to move more when rates change. If rates rise, its price can fall more. If rates fall, its price can rise more. This often connects to time. A long-term bond locks in payments for many years, so future rate changes matter more. But duration is more than the final maturity date. For a beginner, remember this. Credit quality tells you something about repayment, and duration tells you something about price movement. Inflation risk. The money can arrive exactly as promised, and still, it may help less than expected. Inflation risk starts when prices rise faster than the value of the payments you receive. A fixed coupon can look steady on the screen, but if everyday costs rise, that same payment buys less. This is about purchasing power. Interest rate risk changes the market price if you sell. Inflation risk changes what your money can do after you receive it. Stable cash flow can be useful. It does not automatically protect your real spending power. Liquidity risk. Suppose you need the money before the bond matures. You open your account and see a price. That does not always mean you can sell quickly at that price. Liquidity risk means there may be too few buyers, weak quotes, or a wider gap between the price you expect and the price someone will actually pay. This matters more in stressed markets. It also matters with bonds that trade rarely. If you can hold to maturity, liquidity may matter less day to day. If you may need cash early, liquidity becomes practical. The bond can look fine on paper, while the exit price is worse than expected. Call risk. Sometimes the maturity date is less firm than it looks. The bond's terms may allow the issuer to repay early. That is call risk. It often matters when rates fall. If the issuer can borrow more cheaply, it may repay the old higher rate bond and replace it with cheaper debt. For the issuer, that can be useful. For the investor, the attractive coupon can end earlier than expected. A call means the issuer pays you back early under the bond's rules. The key detail is in the terms. Before buying, check whether the bond can be called, when it can be called, and at what price. Reinvestment risk. The money comes back. Now it has to go somewhere. That is where reinvestment risk appears. You may receive coupon payments, maturity proceeds, or an early repayment from a called bond. If available yields are lower by then, the next bond may pay less than the old one. Call risk is the event that can send your money back early. Reinvestment risk is the problem after the money comes back. For someone who wants steady income, this matters a lot. The bond may return your principal, while your future income becomes harder to replace. Currency risk. So far, the risks were mostly about the bond itself. Now add another layer, the currency. Currency risk appears when the bond, or the fund that holds bonds, is tied to a currency different from the one you normally use. The bond can perform well in its own currency. After conversion, your result can look very different. An exchange rate move can add to your return. It can also reduce it, or wipe out the income you expected. This can show up in foreign bonds, global bond funds, and funds that hold bonds in several currencies. Before buying, ask one clear question. What currency is really driving my result? Country risk. Currency is one layer. The country behind the bond is another. Country risk means the political, legal, economic, or financial environment can affect repayment or market value. A government bond in one country can be treated as very safe. A government bond in another country can carry much more stress. The difference may come from public finances, political instability, capital controls, sanctions, legal changes, or pressure on the local currency. This can affect companies too. A company may look stable, but the country around it can make payment, trading, or money transfers harder. So a high yield from another country needs careful reading. It may be paying more because the environment carries more risk. Bond fund risk. Many people do not buy one separate bond. They buy a fund that holds bonds. Here, the format changes the result. With one bond, you can usually see the issuer, coupon, maturity date, and repayment promise. With a bond fund, you own shares of a changing portfolio. The fund may buy and sell bonds. It may hold different maturities, different issuers, and different currencies. It also charges costs. A fund can spread risk across many bonds. That can help with concentration risk. But the fund can still lose value when rates rise, credit conditions weaken, currencies move, or the market reprices the bonds inside it. So a bond fund is a way to get bond exposure. It should still be checked for duration, credit quality, currency exposure, costs, and how closely it matches the reason you wanted bonds in the first place.